All right. So when people talk about investment bank, a lot of people think, oh, it's like a bank, like a commercial bank, right? Or is it not quite the same? Today, we're going to talk about the difference between commercial banks and investment banks, right? First of all, let's talk about commercial banks and get that out of the way. Commercial banks are what you're used to when you think of a bank, right? They have a brand, they typically have branches. You can go and set up an account, a credit card, a checking account, savings account, et cetera, et cetera. Now, the way that commercial banks make money is they take your deposits, the money that you're saving with them, and they lend those out primarily to businesses, but also they'll lend them out to individuals as well in the form of car loans, mortgages, lines of credit, etc. They'll lend it out to businesses, and those businesses will use those loans to help, grow their business, buy more inventory, et cetera, et cetera. And then those same businesses will save a lot of their money that they're borrowing and also cash flow from their operations with those banks. And then that money ultimately gets lent back out. And that's their whole model, right? They basically say, okay, hey, save your money with us. We'll pay you. Well, today they pay almost nothing for savings rates. But, we'll pay you like 0.1% or whatever. And then we're going to lend it out to businesses for 3, 5, 8, 9, 10% interest. And then we'll make money on the difference, right? And if something goes wrong with the business and they can't pay us back, then, we'll come after them and we'll take their assets, et cetera, and sell those off. So that's basically how a commercial bank works, how they make money. An investment bank is a totally different animal. In fact, sometimes I even wonder, why are they even both called banks? An investment bank does a lot of different things. So your typical investment bank basically is broken up into 3 major divisions. You have buy and sell side investment banking, where they're representing companies and helping them raise money. You have sales and trading, where essentially the investment bank is going out and making a market and selling stock and helping facilitate trades and so on and so forth. And then you have research, and research tends to be a smaller division relative to the other two. Research is all about doing research on companies, writing research reports that is then used by sales and trading to sell different product, right? And they have these like Chinese walls between the various groups, so they don't really talk to each other. And that's on purpose for regulatory reasons. Like, you wouldn't want to have on the investment banking side, the investment bankers tell a company, hey, we'll represent you on your IPO. And by the way, we'll have our research division. We'll have them just write really good stuff about you so that you look really good and investors will want to invest in your company, because that would be unethical, right? So they have these Chinese walls, but those are basically the 3 different categories. Now, the banking side of investment banking really comes from the investment bank, where they're doing buy and sell side advisory work, and from the sales and trading side. So for example, if you're a large investor and you want to short a stock, for example, you would work with the sales and trading division of an investment bank to short the stock. The way stock shorting works is basically you go to somebody who holds the stock you want to short. So maybe you think that like Tesla is way overvalued and they're going to come down for sure, right? So you would go to an investment bank like Goldman Sachs and you'd say, hey, Goldman Sachs, I want to borrow like 1,000 shares of Tesla, right? And then what you do is you immediately sell those shares at the current price. So maybe the current price is like $1,000 a share, and you believe it's going to drop down to $500 a share, right? Big drop. Well, you borrow the shares from Goldman, you immediately sell them for $1,000, you pocket that $1,000, and then at the end of the contract you have with Goldman, you go back and you buy those shares at a future date. So let's say the shares drop to $500 a share. You take that $1,000 per share that you spent, you buy back the shares that you sold, but you buy them for $500, so half the price of what you sold them for, and then you return those shares back to Goldman, right? That whole transaction, you are essentially borrowing something from Goldman. You're borrowing these shares. And Goldman is going to charge a fee in order to borrow those shares from them, right? They feel at risk that you're not going to be able to pay them back. Then they may do things like do a margin call, which is like, hey, the stock keeps going up And I'm not sure that you have the money on hand in order to go and buy the stock now that it's gone up to maybe $1,200 a share. So you have to upfront some additional cash to make me feel more comfortable that you're going to be able to give me my shares back. Because what Goldman doesn't want to have happen is that you borrowed those shares, but you can't end up returning them. Just like a bank would worry about lending money to a company and that company getting in trouble and not being able to pay them back. So those are some of the ways in which they're kind of similar, right? Both are lending out to different businesses. The big difference is that investment banks are typically lending to businesses and other investors with a real mindset around investment, right? That's why they're called an investment bank. Commercial banks are more focused on lending to individuals and small businesses, medium-sized businesses, etc. Now, an investment bank also sometimes gets the name investment bank because even though they're not necessarily lending, they are part of the overall transaction when it comes to either lending or raising capital. So you'll have managing directors in the advisory side of the business that are working with companies to figure out what their funding needs are. One example of that could be that a company might need to raise some additional debt through bonds and issue bonds. And an investment bank would help them structure those bonds and then go out to a wide range of investors to sell those bonds to those investors. So you see this happen all the time. Tesla has issued bonds and raised money that way. Meta just raised a bunch of money via bonds. It can be a really great way to raise capital because you're not giving up equity and you're able to get some additional capital. And for investors, it can be great because if you believe that Meta is not likely to go out of business anytime soon, then, hey, you can generate some pretty decent returns on these bonds. So those are and there's a bunch more different things that investment banks do to help finance companies and finance investors. So if you want to use leverage in your trading, and that could be in the public markets, right? So you borrow money from these investment banks and you use it to buy more stock than you otherwise could. Now, an investment bank like Goldman Sachs isn't going to work with me or you on an individual basis unless we're super, super wealthy. They typically are working more with hedge funds, private equity funds, large family offices. We're talking like multi-billion-dollar family offices. They're providing a wide range of debt-related services, investment-related services, etc., to those types of clients. Investment banks also will help on the sell side. So for example, as a venture fund, in my day as a venture capitalist, when we have a company go public, our stake is oftentimes pretty big. And if we were to just dump the shares right away, it could have a very damaging effect on the share price because we would be liquidating so many shares. We oftentimes will work with an investment bank in their sales and trading division because these guys are experts when it comes to buying and selling shares and getting the best possible price. So oftentimes what we'll do is we'll say, hey, here's our shares. They will work on our account to sell those, create a market for them, and try and get the best price possible. And in exchange for that, we pay them a small commission for doing that. So that's yet another way. Ultimately, investment banks make fee on a whole range of different services and lending and other products, just like commercial banks also make a bunch of money on the interest that they're generating off of the various loans. Anyways, hopefully that was helpful to understand the difference between a commercial bank and an investment bank. At the end of the day, again, a commercial bank is going to be like your Wells Fargo, your Bank of America, etc. And your investment bank is going to be more like the JP Morgans, the Goldman Sachs of the world. Now, the one thing that makes it a little bit convoluted that I will just point out is that more and more over time, these investment banks have been acquired or merged or have been created within large commercial banks, which just kind of muddies the water even further. But there's a lot of overlap, as you can tell, right? If I'm lending to a company and that company grows and they do really well, then it would be great to be able to, when they're ready, have an investment bank at hand that can take them public, that can help them raise additional capital that goes beyond what we can do as a bank, as a commercial bank. Thanks for joining me today. Hopefully that was helpful in understanding the difference between a commercial bank and an investment bank. Check out some of my other videos like how to contact a venture capital firm to learn more. Thanks.